Are you wondering how reopening the economy will affect your investments? If so, listen on. So there are a few things that we've been looking at that has to do with how the market's going to do when the economy gets back in play. First is, how many of those unemployment people are really going to get back to work and how fast? That's the number one metric I believe that market participants are going to be checking into. What are those employment figures looking like? And a big thing to look at is, and the biggest clue I would say, is to look at the consumer discretionary stocks, the stocks that are involved with how consumers are spending. Now, I can tell you anecdotally, as I've been driving around here in Denver, we're seeing a tremendous amount of snapback. We're seeing a bunch of people going back, and I believe there's a lot of pent-up demand. So some of the demand that was shifted and taken away from the first quarter, or the second quarter, I should say, are probably going to be pushed in and pushed into the next quarter. So that's one of the things I really want to look at is, what is the unemployment figures look like on a weekly basis, and how are we seeing same store sales improve? The other thing that we're really looking at is, what are these energy companies going to be looking like? Which energy companies are going to be actually taking control of their future and actually being managed well to actually deal with an improvement in the economy? So if they have the right capital structure, if they have the right situation where they are able to be in a position to be profitable again, those energy companies should do pretty well. We currently do not own any energy companies right now. Another thing that we're looking at is there a possibility of a second wave of COVID? Now, I know a lot of doctors are looking at this saying, look, this thing, typically we tend to have another wave, and it's usually a smaller wave on the second run when people start integrating back into the system. Now, you could see examples of huge second waves like with the Spanish flu, but we have a lot different infrastructure now, better medical care, so we probably shouldn't see a big second wave. Now, I anticipate that after we start seeing these numbers, we're going to see a lot of digestion in the gains, because we had a nice bounce up from the bottom. So we're likely to see some of these winners start to digest gains and have more chop. That's one of the things I'm expecting. So right now, when you look at what's happening in our portfolios, how we're positioning for this is really a lot of technology companies are in the position to do the best, and they've been doing well for us. So we're actually very heavily invested in tech right now. We haven't been invested this heavily in tech in a long, long time. We're actually at 66% invested in the dynamic growth strategy. So we went, as if you've been following us, we went from a very low position in tech to a pretty high position now. So we're really moving forward in the technology area. Another thing that we're looking at is we have a lot of healthcare stocks. You know, we're seeing some of these healthcare companies have longer term growth potential. They took a slide and now they look even more attractive. But some of the biggest gains you're likely to see are going to be in the consumer stocks. Now, there's a lot of risk there. We are currently underweighted the consumer discretionary stocks, but we're watching them very closely. We have Dollar General, we have a few others on, and we're also very light on the financials. The financial companies have a lot of kind of headwinds that are keeping them from moving forward. But there are unique plays in the financial services area that we like. Like, for example, there's one position that we own that is very closely tied to bond trading, and the company is actually re-engineering how bond trading is being done. That's a unique situation. I think those are the kinds of things we want to look at. We also think that defensive plays make a lot of sense right now. We own a gold miner. We have some gold itself and some treasuries, long bonds. You want to have a little bit of a position for the potential that we have deflation. A deflationary environment would mean that the long bonds would do very well. We would have more of an emphasis on hard assets. So we really want to have some positioning there. So we think that the reopening of the economy is going to show us a bunch of digestion, and it's going to show a bunch of really focus on employment figures. And there's going to be a big focus on the beaten up consumer discretionary stocks and the beaten up energy stocks. The financials are also in that category. So keeping an eye on them makes a whole lot of sense. But for right now, we like a lot of the tech names, some of the chip names. Many of these chip stocks are lining up at buy points. And we think that a lot of the prior trends that were in place from a technology perspective are really going to be back in play. And there's some international dynamics there that once they start becoming a little more normal could really help things out considerably. Now, one of the things I wanted to kind of close on is that there is a lot of risk in the market still today. And there's something I want to let you guys know. I am going to actually give you guys, if you want to have a copy of my book, The Financial Freedom Blueprint, I'm giving a free signed copy of this book. And this book has a lot of interesting questions that have to do with managing risk. There's a whole chapter called Practical Advice on Managing Risk. So, get a free copy of that. All you have to do is email us at info@wealthnetinvest.com, and we will send that out to you. A signed copy, we'll mail it out to you. This Practical Advice of Managing Risk talks about the basics. What is risk? Does buy and hold make sense? Finding your personal comfort zone, protecting your resources, exploring your own personal profile, and it goes on and on and on. And there's some graphs, showing you a risk profile. So I highly recommend that. And we're doing that because of the situation that we're in right now. We're sending those out to people who ask for it free of charge because we really want to help out. And the other thing is you can get a PDF copy of my chapter in the Handbook of Risk published by John Wiley, talking about how when we have market shocks, how that affects correlation. And the chapter is called Correlation and Converging Correlation in Market Shocks. So get that free PDF as well. We'll have that on the website as a link. But that's it for now. Louis Llanes with Wealthnet Investments signing off. Just want to remember that we want to be looking at the unemployment figures. We want to be looking at the consumer discretionary stocks. We want to be looking at the financial stocks as well as the energy stocks. Have a great day.